Assalamualaikum Doctor and good day. My name is Putri Nur Adila binti Mama Haswa and my metric number is 307585. Firstly, for the executive summary, this report is purposely made to determine the Big Mac Index and purchasing power parity PPP across the assigned country for us, which is Singapore, Hong Kong, Saudi Arabia, Qatar and Kazakhstan, by using the United States as the benchmark economy. Our data were collected on 1st January 2026 from the Big Mac Index and supporting macroeconomic sources. The analysis found that exchange rate do not always align with PPP theory because local economic conditions, labor costs, taxation, productivity differences and non-tradable inputs significantly affect prices. Based on our findings, the Hong Kong dollar HKD appeared to be the most misaligned with PPP theory. Despite Hong Kong having a relatively high GDP per capita and advanced economy, its Big Mac price suggesting substantial undervaluation relative to what PPP would predict. This indicates that factors such as local pricing strategy, labor market condition and exchange rate arrangement cause the currency purchasing power to diverge significantly from the theoretical PPP benchmark. Therefore, the study concludes that PPP provides a useful long-run framework for comparing currency, but real-world economic factors often prevent exchange rate from fully converging to PPP value. For the data methodology, we use a different kind of website and also calculation to retrieve our data. Firstly, for the Big Mac prices were obtained from the Big Mac Index. Its exchange rate were retrieved from XE currency exchange rate based on 1 January 2026. And then for the local Big Mac price was calculated by converting the US Big Mac price using the actual market exchange rate. Next, the implied purchasing power parity PPP exchange rate was determined by comparing the local Big Mac price with the US price, indicating the amount of local currency required to match the purchasing power of USD1 in the United States. And then the percentage of currency undervaluation or overvaluation was then calculated by comparing the implied PPP with the actual exchange rate. Finally, GDP per capita was included to provide economic context and were retrieved from the World Bank database based on the previous year.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Ainina binti Muhammad, metric number 303882. Today we are looking at why a hamburger can tell us if global currency are mispriced. There's a famous economic theory called the law of one price, which says identical items should cost the exact same amount everywhere once you convert the currency. When applied to the whole economies, this is called purchasing power parity, which is the idea that a dollar should buy you the same amount of stuff anywhere in the world. To test this, the economists created the Big Mac Index using the burger as a global benchmark because it is made almost the exact same way worldwide. However, this theory usually fails in reality. Today, a Big Mac costs $5.79 in the US but jumps to $7.99 in Switzerland. So this happens for a few simple real-world reasons. First, shipping ingredients globally is not free. Second, burger vary slightly due to local sourcing. Third, government tariff and taxes block free trade. Most importantly, about 25% of a burger price comes from local costs like rent, labor, and electricity, which you cannot export across border. Finally, companies simply charge a higher prices in the wealthier markets because people can't afford it. So while the Big Mac Index is a great tool, local reality means the one price theory remains just a theory. That's all from me, thank you.
This slide analyzes labor cost and purchasing power across 5 countries with its hourly rate, Big Mac price, and the number of Big Mac workers can operate per hour. Singapore has the highest rate at USD 8.70 per hour and can purchase about 1.42 Big Mac per hour, making its currency its value. Hong Kong records the highest purchasing power at 1.70 Big Mac per hour, suggesting that the Hong Kong dollar is significantly undervalued. Saudi Arabia allows workers to purchase 1.22 Big Mac per hour, but its currency remains undervalued due to its fixed exchange rate with the US dollar. Next, Qatar has the lowest purchasing power at only 0.51 Big Mac per hour, reflecting labor market segmentation and currency undervaluation. Finally, Kazakhstan is included as an effect baseline due to unavailable Big Mac data. Overall, higher labor purchasing power generally supports strong currency valuation, although government policy and market structure also influence the result. Next, the table shows the Big Mac price, national tax rate, pre-tax price, and the resulting pre-tax valuation for each country. The key finding in the countries with higher tax rate experience a larger adjustment when tax are removed. For example, Saudi Arabia with a 15% value-added tax, its undervaluation increased from negative 17.32% to negative 28.10% after adjusting for tax. Same goes to Singapore, undervaluation changed from negative 5.72% to negative 13.50% after excluding GST. In contrast, Hong Kong with a zero tax rate shows no change between its pre-tax and post-tax valuation. This suggests that each currency valuation is influenced more by exchange rate factor than by taxation. In conclusion, taxation can significantly disrupt consumer price and affect our purchasing parity analysis. Therefore, using pre-tax price provides a clear picture of a country through currency valuation and cost competitiveness.
We often look at the Big Mac index to see if a currency is over or undervalued, but it is not as simple as comparing burger prices. So today we are using the Balassa-Samuelson effect to show why this index can be misleading. So economic models assume a burger is just a product, but it is actually a mix of local costs like rent and wages. So as our textbook case, Singapore high export success drives up local service wages, leading to a higher burger price. So it's not about taxes, it's about labor costs. So next is an outlier, which is Hong Kong. Despite its massive wealth, it stays cheap because of a fixed currency pegged to the USD, keeping it artificially undervalued. So Saudi Arabia shows how high sales taxes can hide the true cost of labor. So Qatar, an anomaly. Despite its gas wealth, the reliance on low-wage migrant labor keeps burger prices low, proving that different local rules create different prices. Essentially, currency value isn't just about the burger, it's about the unique local and economy behind it. So, why does the index fail? Here are the three big reasons. First, local costs are immovable. A burger is a bundle of local rent, wages and utilities. Since this can't move across borders, they stay cheap in developing countries, making the currency look weaker than it really is. Next is the geopolitical shocks. So the Iran conflict this year caused shipping and insurance costs to skyrocket. This forced franchises to raise price to cover bill. Not because their local economy got stronger, because Qatar and Saudi Arabia have fixed currency. They couldn't adjust, and these high prices are now stuck for the rest of the year. So next is different brand status. In the West, McDonald's is a cheap everyday meal. Meanwhile, in Asia and the Middle East, it's often seen as affordable luxury. This premium status allows brands to charge more than just the cost of the ingredients. When you add in high import taxes and in competition from cheap local street food, the idea of a standard global price just doesn't work.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Ain Shakila binti Muhammad Kadir and my metric number is 30691. To conclude our presentation, our group found that the Big Mac Index serve can be considered reliable as long-term indicator for determining absolute currency fair value across the countries. This is because they only a rough illustration for assessing currency value and it cannot used for precise financial analysis. As my teammates beautifully demonstrated in labor taxation, the index inherently fails to capture massive domestic non-terrible distribution. Consequently, if we look at these 2026 findings from the perspective of a forex trader, our recommendation is to buy the Hong Kong dollar, Qatar and Arab Saudi Riyal. This is because our empirical data show that these three currencies are heavily undervalued by market force. Executing a buyer or as a buyer allows trader to accumulate this asset-backed currency at a massive discount, setting up highly lucrative arbitrage opportunities when this currency eventually appreciate if central banks adjust or loosen their currency peg in the future. Other than that, for the Singapore dollar, we decide to sell it. This is because the Singapore dollar is already highly market efficient and sits closely to its true equilibrium at minimal distribution. Therefore, there is very little room for further short-term currency appreciation, leaving virtual no opportunity to extract significant profit from price differential. That's all for me. Thank you.